Since our last review, the bulk of our conditions for cutting interest rates have been met. The January 2016 target of 6% inflation is likely to be achieved. Therefore, the focus should now shift to bringing inflation to around 5% by the end of fiscal 2016-17. With weakening global activity since our last review, commodity prices will remain contained for a while. With low industrial capacity utilization, more domestic demand is needed to substitute for weakening global demand so that the domestic investment cycle picks up. The coming Pay Commission report could add substantial fiscal stimulus to domestic demand, but the government has reaffirmed its desire to respect its fiscal targets and improve the quality of its spending. Under these circumstances, the Reserve Bank intends to be accommodative to the extent possible, given its inflation goals, while recognizing that continuing government policy implementation, structural reforms, and corporate actions leading to higher productivity will be the primary impetus for sustainable growth. Now, we do believe that investment, as well as durable goods purchases, are likely to respond more strongly if there's more certainty about the extent of monetary stimulus in the pipeline, even if transmission is slow. Therefore, the Reserve Bank has front-loaded policy action by a reduction in the policy rate by 50 basis points. Given our year-ahead projections of inflation, this ensures that 1 year expected Treasury bill real interest rates of about 1.5 to 2%, which we think is appropriate for this stage of the recovery. While the Reserve Bank's stance will continue to be accommodative, the focus of monetary action for the near term will shift to working with the government to ensure that impediments to banks passing on the bulk of the cumulative 125 basis points cut in the policy rate are removed. This includes, amongst other things, reviewing small savings rates. The Reserve Bank will continue to be vigilant for signs that monetary policy adjustments are needed to keep the economy on the target disinflationary path. Now, we've laid out a number of other policies today. We have a medium-term framework for foreign portfolio investment in government bonds, with a target of allowing FPI ownership of up to 5% by March 2018. We'll also open FPI investment in state government bonds with a target of 2% by March 2018. Now, altogether, this implies incremental space of about $25 to $30 billion over the next 2.5 years, of which $5 billion will open up immediately over the next 6 months. The intent here is to create more room steadily to slant towards long-term investors and to help develop domestic markets. We've also opened to masala bonds. I think that's the name they're called by. These are rupee bonds, and we intend them to have a minimum maturity of 5 years. They can be issued abroad, or they will be issued abroad. For the moment, they will come under the overall corporate FPI limit. We will bring down the ceiling on SLR securities held under HTM from 22% to 21.5% with effect from the fortnight beginning January 9, 2016. Thereafter, the SLR and HTM ceiling will be brought down by 0.25% every quarter till March 31st, 2017. I should say 0.25 percentage points. Now, we've announced increased participation by a variety of players in various markets in our ongoing efforts to improve participation and market depth. We will increase the limit for resident entities for hedging their foreign exchange exposures in the OTC market from US dollars 250,000 to US dollars 1 million without the production of any underlying documents, subject to the submission of a simple declaration. We're also going to examine the possibility of participation by financially sophisticated investors up to certain limits in currency markets without underlying exposure. Let me conclude these opening remarks. The global environment is looking weak for a variety of reasons. Undoubtedly, this is not good news for India because no country is an island. But there is opportunity in even the worst news. we can stand out as a country which still promises strong, sustainable growth. The possibility of realizing this opportunity should encourage us to redouble our efforts to implement our past announcements and to undertake new reforms. The economy has legacy problems to deal with, and there are no silver bullets, as I have said repeatedly. The government, other regulators, and the RBI are turning around this economy through hard work, through pragmatic policies that are not ideological, but based on what works. At the same time, if we are to avoid the mistakes of the past, policy goals have to be steady and predictable so that everyone knows where we are going and can make long-term investments accordingly. I hope these remarks help you understand the policies we have announced today. Thank you.